Hello again, Econ 160, and welcome to another video lecture. Today we are going to be using our tools of supply and demand to think about taxation. Throughout history, human beings have had a complicated relationship with taxes. Benjamin Franklin famously said that nothing is certain except for death and taxes. Former President George H.W. Bush infamously said, "Read my lips, no new taxes." But he wasn't able to keep that promise, and it could have cost him a second term. The American Revolution itself was fomented in the context of a heated tax dispute. Stories about taxes can even be found in ancient Hebrew scripture. When the ancient Israelites demanded a king to rule over them and fight their battles, because at that time not having a secular king meant that you were weak militarily, the prophet Samuel warned them, "These will be the ways of the king who will reign over you. He will take the best of your fields and vineyards and olive orchards. He will take 1/10 of your grain and of your vineyards, and he will take 1/10 of your flocks, and you will be his slaves. And in that day you will cry out because of your king, who you have chosen for yourselves." So it's clear from history that everyone hates paying taxes. But at the same time, most people recognize that taxes are a necessary thing for a functioning government, and that a functioning government is necessary for civilized society. And in fact, we'll return to the role of government in just a few lectures. But economists also recognize that taxation is a distortion in the marketplace. When government taxes the sale of a good, they're basically taking a cut out of every transaction. And that means the amount that a seller receives is going to be less than what the buyer actually pays, and the difference goes to the government. So what effect does this have on markets? Will buyers and sellers still trade as much as they would have without the tax? Will the market outcome be efficient, or will there be deadweight loss? These are some of the questions that we'll be answering in today's lecture. Alright, so here are the learning outcomes for today's lecture. By mastering this lesson, you will be able to, first, explain how a tax on consumers or producers is going to affect the supply or demand in a marketplace. Second, explain why in a perfectly competitive market, it does not matter whether it's the consumers or the producers who are the ones actually getting taxed. Third, calculate consumer surplus, producer surplus, tax revenue, and deadweight loss using a tax wedge. Fourth, explain how tax revenues and deadweight loss vary with the size of the tax. And finally, discuss the role of elasticity in determining the effect of a tax in a market. So we're going to start today's lecture with an example. So here's a competitive market represented by its demand curve and its supply curve. And let's assume that the government decides to levy a $2 tax on every unit which is purchased by the consumers. So what that means is, in addition to paying the price of the good, consumers also have to pay a $2 tax on top of every unit they purchase. And so the question is, what does this do to the marketplace? So to answer this question, the first thing we should realize is that when you levy a $2 tax on the consumers, the marginal benefit of consumers is going down by $2, right? Because instead of just getting the good, they're getting the good, but they also have to pay $2 in tax. So their marginal benefit is going down by $2, right? And remember, the demand curve, you can think of it as the marginal benefits curve, right? And so what that means is the demand curve after the tax should be going down by $2. So here's our demand curve after the tax. All right, and so if we just look at the new demand curve after the tax, we see that the equilibrium price went from $6 to $5, and we see that the equilibrium quantity went from 300 to 250, okay? And so now we can ask, so that's the new equilibrium price, it's $5. And now we can ask, what do sellers actually get and what do buyers actually pay? Well, since it's the consumers or the buyers who are paying the tax, the sellers simply get whatever the market price is, right? So sellers are getting $5 per unit sold. And so let's mark that off here. This is what sellers are getting, $5. What are buyers actually paying though? Buyers are not just paying the market price, right? For every unit purchased, they are paying $5 plus the $2 tax. So what buyers are actually paying per unit is $7, the price plus the tax. And that's over here, right? $7. And so let's mark that off. So it's $7, that's what buyers pay, all right? So this is the effect of the tax. It pushes demand down. The equilibrium price drops from $6 to $5. The equilibrium quantity drops from 300 to 250. Sellers are now getting $5 instead of $6 for every unit that they sell, and buyers are now paying $7 instead of $6 for every unit that they purchase. So now let's ask what happens if they tax the producers instead of the consumers. So we're in the same market as before, but now we're going to suppose that the government, instead of taxing the consumers, they levy a $2 tax on every unit sold by the producers. So what does this do to the market? So the first thing to realize is that when you have a tax on producers, what happens is the marginal cost of the producers is going to go up by the amount of the tax, right? Because now for each unit they sell, there's an additional cost to pay, which is the tax that they have to pay to the government. And remembering that the supply curve is equal to the marginal cost curve, what that does is the tax pushes the supply curve up by exactly $2. So here's our supply curve after the tax. So what does this do to the equilibrium? The equilibrium price goes from 6 to 7, and the equilibrium quantity drops from 300 to 250, right? So that's what it does to the equilibrium of the market. And now let's ask, what does it do to what buyers and sellers actually, what buyers actually pay and what sellers actually get? Well, since buyers are not paying the tax, what they actually pay is simply the market price, right? So buyers are paying $7, okay? And so let's mark that off. Buyers are paying $7. What are sellers actually getting? Well, sellers don't get the full market price anymore, right? They actually get the market price minus the tax, which is $5. So sellers are getting $5, the price minus the tax for every unit sold. And let's mark that off here. Okay? So to summarize, what was the effect of the tax? It pushed the supply curve up. The equilibrium price went up from $6 to $7, and the equilibrium quantity fell from 300 to 250. Okay? Buyers now pay $7 instead of $6 for each unit, and sellers now get $5 instead of $6 for each unit. Okay? So what are some lessons we can draw from our two examples just now? The first is that the main effect of a tax is to drive a wedge between what buyers pay and what sellers get, right? So buyers are going to pay more than what sellers get. And the difference between what buyers pay and what sellers get is basically the amount of the tax, right? Because the difference is the cut that the government is going to take out of every transaction. And that's going to be true regardless of who's paying the tax, right? Whether it's the sellers paying the tax or the buyers paying the tax, the wedge between what buyers pay and what sellers get is always simply going to be the size of the tax, right? So that's our first lesson. Our second lesson is that in our two examples, the effective prices of the consumers, meaning what they actually pay, and the effective prices of the producers, meaning what they actually get, turned out to be the same, right? Regardless of whether the tax was levied on consumers or producers. So the diagram right now is showing the effect of the tax on producers, and we can see that with the tax on producers, buyers are paying $7 and sellers are getting $5. But then if we look at what happens with the tax on consumers, right, this is what happened with the tax on consumers, we saw that still buyers ended up paying $7 and sellers ended up getting $5, right? So the lesson here is that regardless of whether you have a tax on producers or a tax on consumers, the effect on what buyers actually pay and what sellers actually get is going to be the same. And so a natural question to ask after showing this result is whether that's always going to be true for any tax or whether it's specific to the example that we gave. And so that's what we're going to be exploring next. But before we do that, we have to introduce a new concept first known as the tax wedge. And the tax wedge is kind of a tool for graphical analysis that's going to help us analyze taxes in a much easier way. And so here is a tax wedge. It's basically a straight vertical line. And what the tax wedge represents is it represents the wedge between what buyers pay and what sellers get. So the top of the tax wedge is going to be what buyers pay, and the bottom of the tax wedge is going to be what sellers get. And so the height of the tax wedge is going to be the size of the tax, right? So what buyers pay is up here, what sellers get is down here. The vertical height is the distance between what buyers pay and what sellers get, and of course that is the amount of the tax. Okay, so that's a tax wedge. It's just really a vertical line. But how do we use the tax wedge? We're going to take this tax wedge and we're going to basically shove it into the supply and demand curve like this until it can't go any further. And the tax wedge is going to tell us everything we need to know about the equilibrium after the tax. So the top of the tax wedge is going to tell us in equilibrium what buyers are going to pay after the tax. The bottom of the tax wedge is going to tell us what sellers are going to get per unit after the tax. And the horizontal location of the tax wedge is going to tell us what the equilibrium quantity transacted is after the tax. So why does the tax wedge work? The tax wedge works because the demand curve is really telling us what the quantity demanded is based on the effective prices of the consumers, right? Based on what they're actually paying per unit of the product. And the supply curve is really telling us the quantity supplied based on the effective prices of the producers. That is what they actually get per unit of the product. And now, since there's a difference between what buyers pay and what sellers get, quantity demanded is no longer going to equal quantity supplied at the equilibrium price, but rather at the tax wedge, right? Because here, buyers are paying $7 per unit, and so their quantity demanded is $2.50. And sellers are getting $5 per unit, and so their quantity supplied is also $2.50. And so the market is in equilibrium, right? And so the tax wedge is where the market will be in equilibrium under a tax. So what can we learn from the tax wedge? So one thing to notice is that the tax wedge is always going to be the same size regardless of who the tax is levied on, right? Because the tax wedge shows us the difference between what buyers pay and what sellers get. That's always going to be equal to the cut that the government takes regardless of who they're taking it from. So the size of the tax wedge is always going to be the same. It's going to be the amount of the tax regardless of who the tax is being taken from. And second, for the same size tax, the tax wedge is always going to fit in the same place in the supply and demand diagram, right? So this is a size 2 tax wedge. The height is $2. And there's only one place in the supply and demand diagram where the wedge is going to fit, and that's right here, right? And since that's going to tell us what buyers pay and what sellers get, the conclusion is that it doesn't actually matter in a competitive market who the tax is levied on. Ultimately, regardless of whether it's buyers paying the tax or sellers paying the tax or some combination of both, the effective price in terms of what buyers actually pay per unit and the effective price of the producers in terms of what sellers actually get per unit is going to be the same regardless of who you're taxing. Okay, and so how does that kind of play out in practice? What that means is that if you try and levy a tax on consumers, what's going to happen is that the prices are going to drop, right? So the consumers don't actually bear the full burden of the tax. And some of the burden of the tax is going to be paid by the sellers through lower prices. On the other hand, if you levy taxes on producers, then prices are going to rise. So producers don't actually bear the full burden of the tax either. Some of the tax is going to be passed through to consumers through higher prices. And ultimately, who bears the actual burden of the tax, regardless of who legally is the one having to pay the tax, is known as the economic incidence of taxation, okay, or simply the tax incidence. So in this case, even if we tax the buyers only, sellers would still bear some of the economic incidence through lower prices. Or if we taxed only the producers, consumers would still pay some of the economic incidence through higher prices. So to summarize, economists say that there is an equivalency between consumer and producer taxes in competitive markets. In a competitive market, it doesn't matter whether taxes are levied on consumers or producers, the ultimate economic incidence of taxation will end up being equivalent. If consumers are taxed, then some of the tax will be passed on to producers through lower prices. If producers are taxed, then some of the tax will be passed on to consumers through higher prices. And this has two important implications. The first implication is we don't actually need to know who the tax is being levied on in order to predict the effects of the tax. We only need to know the size of the tax. The second implication is that it's not easy actually for governments to control who bears the burden of taxation in a competitive marketplace. They definitely can't control it simply by changing who they tax. And so let's give an example from the labor market. Let's assume the labor market is competitive. And so the question is it better to tax workers through a personal income tax or to tax firms through a payroll tax? And for some people who may favor workers over firms, their instincts might say, well, we should tax the firms because the firms have more ability to pay. But the problem with that logic is that it ignores the equivalency of consumer and producer taxes. Our economic theory would tell us that even if you tax the firms, some of the burden of taxation is going to be passed on to the workers in the form of lower wages. Of course, one caveat to that argument is that it only works assuming the labor market is perfectly competitive, which it might not be. And so it's always important to keep in mind whether the markets that you're analyzing fit into the assumptions that you're using to analyze it. And we'll talk about how to analyze non-competitive markets later in the course. Now let's talk about how we can use supply and demand to calculate consumer surplus, producer surplus, and tax revenue under a tax. And so this is the example we're going to use. Here's a supply and demand in a competitive market right here. And we're going to ask if the government levies a unit tax of $4 on every transaction in the market. Number one, what is the effect of the tax on the quantity traded and on the effective prices? Number two, how much revenue does the tax raise? And number three, what is the consumer and producer surplus under the tax? So let's tackle question one first. What is the effect of the tax on the quantity traded and on effective prices? As with any tax analysis, the first thing we want to do is to draw the tax wedge. All right, so here's a tax wedge. The height of it is exactly $4. And we are going to shove it into the supply and demand diagram like so until it fits nice and snug. And that's going to tell us what the effective price of the consumers is and what the effective price of the sellers is. All right, and then now we can look at what the tax does to the market. So quantity goes from 300 down to 200. The effective price of the consumers is $8. And the effective price of the producers is $4. So that's our answer to question one. Question two is how much tax revenue does this tax raise? So to calculate tax revenue, we want to use this formula. The total revenue of the tax is equal to the size of the tax, meaning the amount that you're charging per unit, times the quantity that's traded, right? Because that's going to be the total amount of tax that you collect. And that can actually be represented graphically by the rectangle which is to the left of the tax wedge. And why does that work? Because the length of the rectangle is the quantity traded, right? That's 200. And the height of the rectangle is the height of the tax wedge, which is the size of the tax, which is $4. And so our tax revenue is equal to $4, the size of the tax, times 200, the quantity traded, which is 800. And so that's our answer for question two. The total tax revenue raised by this tax is $800. Now let's do question three. What is the consumer surplus and what is the producer surplus under the tax? So to calculate consumer surplus, what we're going to want to do is we're going to want to add up the marginal benefits of the consumers, subtracting out what they're actually paying per unit, right? So not what the actual market price is, but what effectively they're paying per unit, their consumer's effective price. And since the demand curve is the marginal benefits curve, and what buyer's paying is right here, adding up marginal benefits minus what buyers pay gives us this triangle. And so this triangle is our consumer surplus. The width of the triangle is 200, the height is 4, and so consumer surplus is 1/2 times 200 times 4, which is $400. Now to calculate producer surplus, what we're going to want to do is we're going to want to add up what sellers actually get, so the producer's effective price minus their marginal costs. And since the supply curve is the marginal cost curve, adding up what sellers get minus their marginal costs gives us this triangle. So this triangle is producer surplus. The width of it is 200 and the height is 4. And so producer surplus is 1/2 times 200 times 4, which is again $400. Okay, so in this example, both consumer surplus and producer surplus under the tax are $400. And so now we can calculate what the total surplus is to all market participants under the tax. Now, one thing to keep in mind is that when there's taxation, then we also have to include the surplus to the government as well, because the government is also a market participant. And you can think of the tax revenues that it's raising as being paid out to government employees or to government contractors and just being used for some purpose. And so we do want to calculate the surplus to the government as well. So with the tax, then total surplus is going to be consumer surplus plus producer surplus, and finally plus the tax revenue, because that's the amount of money the government's able to raise. Okay, and we already calculated these quantities. If you'll remember, consumer surplus was 400, producer surplus was 400, and tax revenue was 800. So if we add those up, we get that total surplus under the tax is 1,600. Okay, and so now we can also ask, what would the total surplus have been without the tax? Right, and we already learned how to do this in the previous lecture. Without the tax, the consumer surplus would have been this entire triangle here. The producer surplus would have been this entire triangle, okay? And so the total surplus without the tax would have been this whole big triangle, and the width of that big triangle is 300, and the height of it is 12. And so the total surplus without the tax is 1/2 times 300 times 12, which is 1,800. So we can see that the tax actually resulted in a loss in total surplus of 200. And so if you remember from last lecture, we defined deadweight loss as the loss in total surplus which results from a market distortion. And we just showed that in our example, the $4 tax gave rise to a $200 loss in total surplus. And so that means our tax resulted in a deadweight loss of 200, okay? And we can actually represent deadweight loss graphically, because if you look at the total surplus under the tax, which was this, right, this shaded area was the total surplus under the tax, and this was the total surplus without the tax, and then you compare the two areas, right, what you see is that the loss in total surplus is given by this triangle here, right? And we can calculate that graphically. The width of the triangle runs from 200 to 300, and so that's a width of 100. And the height runs from 4 to 8, and so that is 4. And so the deadweight loss is 1/2 times 100 times 4, which is 200, which is exactly what we calculated before. So now let's try to interpret that deadweight loss. Why is it the case that taxation always gives rise to a deadweight loss? Now, if you'll remember what I said from the very beginning, I said that taxation drives a wedge between what buyers are paying and what sellers are actually getting, right? And so because of that wedge, there are going to be some mutually beneficial transactions that would have occurred that are no longer taking place in the market, right? And so that's the 200th to the 300th transaction are no longer taking place in the market. And so what are these transactions? These are the transactions for which the marginal benefit to the consumers minus the marginal cost to the producers does not exceed the size of the tax, right? So the marginal benefit minus the marginal cost, which is this distance, is smaller than the tax. And when that's the case, right, when the mutual gains from trade between the buyer and the seller are smaller than the size of the tax, which is the cut that the government wants to take out of the transaction, there's no way for the buyers and sellers to transact anymore and still be mutually better off, right? And so those transactions no longer take place because of the tax. So 200th to 300th transaction, which without the tax would have been mutually beneficial, now are no longer mutually beneficial and therefore no longer occur. And so we have a reduction in the quantity traded in the market, okay? And then these are the lost gains from trade. And so if we add those up, add up the marginal benefits minus the marginal costs for the transactions that are lost, we get the deadweight loss, right? And so you can think of the deadweight loss as the lost gains from trade or the lost mutual benefits from the transactions that no longer occur. So our main lesson for today then is that although taxes are indeed necessary for government, and we'll talk more about the role of government later, they do have to come at the cost of a market inefficiency in the form of deadweight loss. So we showed that tax revenues are necessary, but that taxes give rise to deadweight loss. So a natural next question to ask is, how do tax revenues and how do deadweight loss vary with the size of the tax, right? So as we go from a small tax to a medium tax to a large tax, how does revenue and deadweight loss change? Now, for tax revenues, the answer is that when the tax size is small, then tax revenue is also going to be small, right? Because you're going to get a really thin rectangle with a very small height due to the small size of the tax. But at the same time, you don't kill too many transactions in the market, all right? But small tax means small revenue. Now, if you raise it from a small tax to a medium tax, you get an increase in the tax revenue. So a medium tax gives rise to a medium tax revenue. Now, if you increase it still further, you actually end up reducing your tax revenue. So a large tax is going to result in small tax revenue. And that's because even though you're going to get a lot of tax per unit transacted, you're really killing a lot of the transactions in the market, right? So your increase in the size of the tax is going to be offset by a reduction in what's called the tax base, the number of taxable transactions that you can levy the tax on. And so once the tax is very large, you again get this very thin rectangle and a small tax revenue. And you can even think about going to the extreme. If you make the tax so large that you kill the entire market, then of course your tax revenue will be zero. And so the relationship between the size of the tax and tax revenue is what's called the Laffer curve. All right, so this is what the Laffer curve looks like. We're going to put tax revenue on the y-axis, and we're going to put size of the tax on the x-axis. And the Laffer curve looks like this. It looks like a hump-shaped curve, right? Because when you start from a very small zero tax revenue is zero. As you increase the size of the tax, your tax revenue goes up. But there comes a point where as you increase the size of the tax still further, the gains that you get in terms of the size of the tax become more than offset by the reduction in the tax base, and your tax revenue actually starts to go down. All right. And so if you've ever heard someone say that if we reduce taxes, we're going to increase economic growth, increase people's income, and increase the size of the tax base, and that this is actually going to be increasing for tax revenues, then you know that their argument is that we're on the right side of the Laffer curve, right? And so public debates about taxes sometimes revolve around where we are in the Laffer curve. If someone tells you that we can actually increase tax revenues by reducing our tax rates, then they think we're on the right side of the Laffer curve. If someone disagrees and thinks that increasing tax rates will increase tax revenue, then they think we're on the left side of the Laffer curve, okay? And to be upfront about it, most economists would not agree, at least in the short run, that we are on the right side of the Laffer curve. At least in the short run, most economists would think that we are on the left side of the Laffer curve. So that was how revenues vary with the size of the tax. Now let's ask how deadweight loss varies with the size of the tax. And so the answer for deadweight loss is that when the size of the tax is small, deadweight loss is also going to be small, right? Because you're not killing too many transactions in the market. When the size of the tax is medium, then you're going to get a medium-sized deadweight loss because you're killing a little more, right? A medium amount of transactions in the market. And if you have a very large tax, then you're really killing a large portion of the transactions of the market, and that leads to a very large deadweight loss. And so the answer is that for deadweight loss is always going to be increasing as you increase the size of the tax. And so if we were to plot the relationship between deadweight loss and size of tax, we would get an increasing relationship that looks like this, okay? And so ideally, when it comes to tax policy, when we're deciding how best to raise tax revenues, we would ideally want to be generating the most revenue at the lowest possible deadweight loss. And so that's what we're going to talk about next. So for a given amount of tax revenue, if we would ideally want to raise it at the lowest possible deadweight loss, an important question to ask is, are there going to be some markets for which deadweight loss is going to be smaller and some markets for which deadweight loss is going to be higher in order to generate the same amount of tax revenue? And the answer is there are differences across markets, and that it depends on the supply and demand elasticities in the market. And so let's take a look and see why that's the case. Here on the slide, I have a market with an elastic supply curve, right? So this is a very elastic supply curve. And I have a market with an inelastic supply curve. So this is a very inelastic supply curve, all right? And we're basically going to be looking at what is the effect if we put in the same sized tax, represented by this tax wedge here, into each of these markets. So let's go ahead and put this tax wedge into the market with the elastic supply curve. And let's go ahead and put this tax wedge into the market with the inelastic supply curve. All right, and so tax revenue in market A is this green rectangle. Deadweight loss in market A is this purple triangle. Tax revenue in market B is this green rectangle. And deadweight loss in market B is this purple triangle. And now remember, these taxes are the same size in both markets, and so the sizes of these figures are comparable. And if you look at the size of the tax revenue in market A compared to the size of the tax revenue in market B, you can see that market B has more tax revenue, right? And that's because this tax did not kill as many transactions in market B as it did in market A. And because of that also, you can see that the deadweight loss in market A is actually greater than the deadweight loss in market B. And again, it's because in market A, you have more lost transactions than in market B. And so now let's compare a market with an elastic demand curve. So market A here has a very elastic demand curve to a market with an inelastic demand curve. So in market B here, we have a very inelastic demand curve. Okay, and so again, we're going to be putting the same size tax into each market, and we're going to be comparing their tax revenues and deadweight loss. And again, the sizes of the tax are the same, so these figures are comparable in scale. And so you can see that in the market A with the elastic demand curve, tax revenue is smaller and deadweight loss is higher. And in market B with the inelastic demand curve, tax revenue is higher and deadweight loss is smaller. All right, and so the conclusion of our analysis is that when markets have supply and demand curves that are more elastic, then the tax is going to result in higher deadweight loss and lower tax revenue, right? And this is because when supply and demand is more elastic, that means the behavioral response of the market participants to the tax is going to be larger, right? That is, consumers and producers are going to reduce consumption and production more in response to the tax in a more elastic market. And because they reduce their consumption and production more, this results in more lost trades and more deadweight loss. Okay, and it's exactly vice versa for a market with inelastic supply or demand curve. If supply or demand is inelastic in a market, then the behavioral response will be small, and there will be a smaller number of lost trades and therefore smaller deadweight loss. Okay? And so because of this crucial dependence of deadweight loss and tax revenue on elasticities, public debates over taxes, whether politicians know it or not, it often boils down to people's views on elasticity, all right? So if someone says raising the state income tax on high earners is going to cause them to move to another state, and therefore we should not raise the state income tax, now this person is taking on a view that the labor supply curve of high earners is very elastic, right? Because what they're saying is that raising the tax is going to induce a large behavioral response from the labor supply of high earners. If someone, on the other hand, says that, no, raising the state income tax will not result in much outmigration of high earners, then this person is taking on the view that the labor supply elasticity of high earners is actually quite inelastic because they don't think that the tax will induce much of a behavioral response. Okay? And so, like I said, whether people know it or not, a lot of the times the arguments they make for and against raising or lowering taxes comes from their points of view on the relevant demand or supply elasticities in the market. So I'm going to close the lecture by telling you a story about Henry George. And this is Henry George right here. Henry George was an American economist and journalist, and he's most famous for arguing that the most just and fair tax that you could use would be a tax on land. And that's going to be a tax on land regardless of what it's used for or the structures that are built on top of it. And in fact, many economists actually agree with Henry George's assessment. And so now we're going to use our tools of economic analysis to think about why Henry George believed this. Let's start by drawing demand and supply in the market for land. Now, the key feature of the market for land is that it has a very inelastic supply curve. And that's because there's basically a fixed amount of land in any given country, and you can't really produce more of it, and you certainly can't reduce the amount of land that the country has, at least not through market means. And now we're going to ask what happens if we put in a tax on land. So here's the tax wedge that's going to represent our tax. And as always, we're going to shove that tax wedge right in between the supply and demand curves. But because supply is perfectly inelastic, the wedge just goes all the way to here, right? And based on the wedge, this is what consumers of land are going to pay for land. So these are, you can think of this as what the renters or the tenants of land are going to be paying their landlords. And then because of the tax, this is what sellers, and you can think of those as the landlords who are leasing to tenants and renters, this is what sellers are going to get for their land. And this is tax revenue. And finally, if you notice, there's no deadweight loss, and that's because supply of the land is perfectly inelastic, which means the quantity of land which gets traded after the tax is still exactly the same as before the tax, and so there are no lost trades, and therefore there's no deadweight loss. Okay, and so that's reason number one that Henry George thought that a land tax would be very effective, because it doesn't result in any deadweight loss. And here's reason number two. If you look at the effective prices of the consumers and of the producers relative to the previous market equilibrium, what you see now is that with the land tax, the consumers of land, meaning the renters and the tenants, they don't actually bear any of the burden of the tax, right? Because what they end up paying after the tax is exactly the same as what they would have paid before the tax at the market equilibrium. And so in terms of the economic incidence of the land tax, it falls entirely on the landlords, right? The sellers of land. And to the extent that in most societies, including America, landowners tend to be wealthier and better off than renters and tenants, then a land tax is also progressive in the sense that it's going to be the wealthier and the more well-off in society that bear most of the burden of the tax. And so these are the two reasons that Henry George thought that a land tax would be the most just and fair tax to use. All right, so here's a quick review of what we covered in today's lecture. First, the main effect of a tax is to drive a wedge between what consumers actually pay and what sellers actually receive. Second, a tax on consumers is going to shift the demand curve downwards by exactly the amount of the tax. A tax on producers is going to shift the supply curve upward by the amount of the tax. But in competitive markets, the economic incidence of the tax in terms of who ultimately bears the burden of it is going to be the same regardless of who the tax is levied on. We can calculate effective consumer and producer prices and consumer and producer surplus and tax revenue and deadweight loss using the tax wedge in a supply and demand diagram. There is a non-monotonic relationship between tax revenues and tax size, and so revenues increase at first when you increase the size of the tax, but then they decrease, leading to a hump-shaped relationship known as the Laffer curve. On the other hand, deadweight loss is always increasing in the size of the tax. And finally, deadweight loss is going to be smaller in markets with a more inelastic supply or inelastic demand curve, and revenue will be higher, and vice versa in markets with elastic supply and demand curves. All right, so that is the end of today's lecture. Thank you for sticking around. In the next lecture, we're going to be applying our tools of supply and demand to thinking about international trade. See you next time.